Report capital loss carryovers. First of all, what are capital loss carryovers? In simplest terms, they refer to how a business is given the opportunity to eventually recover their losses via carrying these figures over to future years' capital gains, or by reporting the capital loss for tax deduction. In the United States, companies that suffered capital loss can claim a maximum of $3,000 tax deduction. The remaining amount can then be arranged as capital loss carryovers, $3,000 at a time, as tax deduction for the next years. In addition, a company could arrange for the capital loss to be carried over not just for tax deduction but to offset the capital gains. For example, if capital loss remained at $2,000 for 1 year and the capital gains for that year went to $3,000, the total profit, the figure that becomes taxed, is at $1,000. With that being said, obviously reporting capital loss carryovers is important so that a company will be able to take advantage of the tax breaks. Here are some important guidelines to remember when reporting capital loss carryovers. Have a copy of the income tax return form. In particular, you will need Schedule D, which is part of the form that has to do with reporting capital loss carryovers. You could download a copy of this form, along with other important IRS forms, at the IRS official website. You could also obtain copies at your nearest local legislative office. Know how to fill out Schedule D. At this form, you should first report all your company's income from the previous year. You will first need to report your short-term capital gains. These are gains that your company has held for less than a year. Next, report your long-term capital gains, or gains that your company has held for more than a year. Input these information in lines 1 and 8, respectively. Fill out the capital loss. Subtract this from your reported capital gains. The difference will be your total gain, if the difference is positive, or loss, if the difference is negative. Consult your tax return from the previous year. Check to see the amount of carryover that you reported. You should now place this amount over to line 14 of the Schedule D form Part 2. Keep good records of all your short-term gains and losses, as well as long-term ones. If you're a small company and you do your own financial reports, it's very important that you regularly maintain your records so that you won't panic once tax season comes in. If you have all your records and papers in order, you will better be able to systematically report your capital loss carryovers. There you have it. These are the important guidelines to remember when reporting capital loss carryovers. As mentioned, being systematic and organized is key. You will have to make sure that all your reports are accurate, or else you might get into financial trouble. If you're not sure about some details of your report, you may want to consult financial advisors just to make sure that all your financial data are accurate, and so you could learn more about taking advantage of legal tax breaks available for your situation. Good luck, and hope this helped.